microphone and the screen, and then we can start into the markets, look into the markets.
Die Stummschaltung ist aufgehoben.
Great. Good morning, guys. Good morning. Good morning. Can you hear me okay?
Yes, I can hear you. Wonderful.
Okay, excellent. I'm just trying to get the chat box up. Hey, good morning, Chris. Hi, Vincenzo. And good morning, Dees, Alex, Rolf. Excellent. Good to see you guys again. Now let's share the screen and then we get going. I think I was off last week, right? So we need to catch up on that. We need to catch up on that. It was an important week. And then, wow, do we have a trade war going on or what, guys? Wow, wow, wow. And oil is rising on a couple of headlines that may not be sustainable. But okay, disclaimers in full effect. Picture of me, you only hear my voice. Last week, I was looking to short the Aussie versus the Kiwi. And recall, at the time, the money markets were pricing in even probabilities for each central bank to cut the rates. And I was under the assumption, naive as I am, that a central bank would do what it is legally bound to do as per its charter. And the RBA clearly states, point number 1 in the charter, if inflation is too low, we got to act. And inflation at the time that I came up with the trade idea was at a 3-year low. And last time they acted, and this time they did not. Granted, it was 11 days prior to an election. So again, another central bank after the Fed that appears to be acting politically. And that, ladies and gentlemen, is a slippery slope. We should not go down that path where central banks go with the flow or being influenced by politics. Very, very, very dismal outcome if we go there. But we went there, and what happened is exactly what the risk to the trade stated. If the cuts come different from my expectation, and they cut the opposite. So what I actually did is I turned the position around, but officially for this account, it is a loss. So what I did is I took the loss and then I turned around and I made up for it in the long, but officially that's not what we communicated here. I did state at the time it's aggressive. So here we go. We have a loss. Excellent. Headlines this morning. Risk off. We saw Australian equity indices down 40 basis points. We saw the Nikkei get hampered on yen strength. The equity market over there down by 2%. We saw Shanghai down by over 1%. The SPOOS is down by over 1% and the DAX down 2%. Yen rising, dollar yen off about 25 basis points to 109.60, and the Dixie is holding. It is holding. Ladies and gentlemen, if you're long emerging markets, please be careful. You might get hit hard here. A few years ago, we had the similar situation as per the chart that you're seeing below, where the dollar renminbi is trading towards 7. Option market is already implying that the 7 exchange rate will get hit, and that's going to be a problem. So the Chinese are not looking to retaliate via selling treasuries, of which they hold roughly 1.7 trillion. Small number. I'm joking, being sarcastic, but it looks like they're adjusting via letting the renminbi, their currency, weaken. And that was horrific for emerging markets last time around that happened. So please, please, please keep an eye on that. This is what we expect happening next, the 7 to fall. We have clearly identified by the Chinese 3 major issues where the disagreements are stemming from, and that is 1, removal of all remaining tariffs by the Americans, not going to happen. Differences in wording of the agreement, probably not going to happen. And China said to view U.S. import targets as unrealistic. Agree, but probably not going to happen. The Americans are very upset about intellectual property theft, rightfully so, but one needs to understand that copying is part of the Chinese culture. If you do not understand that, and us Westerners, we do not understand that, so again, you can't get a round thing through a peg, a square, it doesn't work, and so this trade war is expected to stay with us for a lot longer. Now, the problem is the Americans have beef with the Mexicans and with the Canadians, and that new NAFTA agreement is not even ratified by Congress yet. And now they're starting, the Americans, potentially another trade war with the Europeans, and they're trying to get to terms with the Japanese. I recall a guy a few years ago who had wars with the whole world on all fronts, and that didn't go over too well. So I'm very pessimistic when it comes to the story that the market played until a few days ago, i.e. Global economic recovery in the second half of 2019. Don't really see that yet. I also perceive a potential recession in the US probably quicker than the next 2 years. The yield curve inverted already again based on all this mess. This is a mess. This is a serious trade war. It's very, very serious. Next, the US reportedly gave China their bottom line, in which China now have 3 to 4 weeks to react before more tariffs on 325 billion of Chinese imports are being introduced. So not only did we hike the tariffs last Friday, within 5 days, announced via Twitter on Monday, within 5 days from 10% to 25%, now Trump is looking to tax everything. And that is going to be horrific because most of these tariffs are being paid by US consumers and US small businesses and US farmers. But the Chinese are also hurting. Bloomberg last week came up with a research piece stating if everything is getting taxed, then Chinese GDP may decrease by 1.5%. 1.5%. But then this morning, one of my traders, thanks Marcus, posted a research piece that actually stated only by 30 basis points may GDP growth be hindered. In any case, nobody is winning this. Everybody's going to suffer. A recession doesn't help anyone, but it looks like we're heading that way. All right. Again, there's lots of interesting research pieces out that the U.S. small businesses and U.S. consumers are paying for these tariffs and not the Chinese. And the next step, taxing the remaining 325 billion of goods and Chinese imports that have not been taxed yet. These are actually the technology goods, right? So your iPhones are going to get more expensive on top of everything else. So where it was washing machines and luggage, the next round is going to be everything. Tech items, and it's going to be, luckily I'm long gold and long treasuries. That is a good hedge to have in place right now. If you're still long equities, please hedge, guys. Okay, Prime Minister May is being pressured by her cabinet ministers to launch a final attempt to reach a compromise in Parliament. Let me think about how many times have I heard this? Sorry, I lost count. Okay, so I'm currently not able to really swing trade the pound. I can day trade it based on headlines crossing the wire, but I'm not able to swing trade it. It's just too messy. Then we had recent polls ahead of the European elections that are taking place, which the joke of all times is that the Brits now have to participate in. And the Brexit Party ranking coming in with 34%, Labour slipping down to 21%, and the Conservatives collapsing to just 11%. So naturally, the political landscape in the UK may change. Strength versus weakness this morning, as we can see, bottom left-hand corner, we had a little bit of pound recovery strength and then coming off. We had the antipodeans getting hit except Canada. So Aussie and New Zealand getting hit based on the trade war. Yen seeing risk of inflows based on the trade war. Headlines deteriorating, but Canadian dollar holding solidly. Why? We had a super employment report coming out on Friday. I mean, it was unbelievably good. So oil rising, employment good, Canadian dollar strong this morning, or could be stronger. If sentiment changes, one little more positive tweet by Trump would be enough. Sentiment changes right away. You'll see Aussie, Kiwi, and Canadian dollar rally and the yen coming off. Dollar. What do we have? Retail sales on Wednesday in the US expected to come in lower than the prior number. The headline number may drop due to a decline in light vehicle sales. In April, they declined by 1 million units to 16.4 million. Now recall, on Twitter, I said that last time, there's lots and lots of financial guys stating how dismal the vehicle sales are coming in, and this is ringing in or a harbinger of a recession. If you look at history, auto sales peak in the middle of the cycle. So this is not really the best indicator to use for a potential recession. i.e. timing the next recession. Then we had the pace of strong March number expected to slow a bit. Because March number came in really strong, it's okay that this is coming off a bit. We still have in the background very robust spending growth, and we saw an acceleration or re-acceleration in chain store sales and solid aggregate income trends in the US because we have full employment. All right. So we don't really necessarily expect a sustained reaction on this number. It could be that the number reacts if it comes in weaker than expected, the dollar were to continue to sell off further, but there may be some completely different reasons in the background for an expected dollar weakness, okay? So here you can see the retail sales numbers and the core numbers. On to the euro. On Wednesday, we have German preliminary GDP. That is Q1 of 19, and that's expected to come in 40 basis points better than the flat reading last time, and 70 basis points versus 60 basis points on an annualized basis. Please recall that over here in Germany, we narrowly avoided a technical recession in Q4 of 2018. It was very narrow. Now, the numbers were supported by last week's German industrial production, which came in better than expected, a full % better than expected. It was expected to contract by 50 basis points, came in green. Also, we have final services in Germany, or the services sector, coming in stronger than expected, supporting the GDP growth. And we have retail sales that we expect to show a stronger reading on a Q-on-Q basis. On May 31st, we'll have the month-on-month reading. So looks like the German consumer is spending. But what are the weak points when it comes to the German economy? We had really bad new industrial orders, which obviously are a leading indicator to the GDP number. And those came in worse or as bad, the worst since the global financial crisis last quarter. And then we recently have had the Bundesbank commentating that they said that the rebound in the first quarter was likely driven by temporary factors. So that's not very bullish. You can see GDP growth contracting and then coming in flat. Would it had it contracted in the fourth quarter of 18 as well, then 2 quarters in succession with negative GDP growth is the definition of a recession. Hence, we said we narrowly avoided a recession last quarter. And then you can see on the bottom right-hand side the annual growth rate of the GDP over here. And that is not a very encouraging picture that we see here. On to the pound, we have average earnings index and employment numbers coming out on Tuesday. And as we all know or should be aware is one, we have average earnings growth in the UK, which is positive, which would also mean if there were no Brexit saga, the Bank of England would already be in position to hike rates. And we have full employment with unemployment being below 4%. We expect the claimant count change to drop to 24 versus 28K. RBC believes that the wage growth in the UK has peaked, and they are forecasting a slight moderation in the coming months. So, okay, naturally, I concur with that. And we just had broadband on the wire this morning, reiterating that the Bank of England bank hike will be gradual if and when Brexit is out of the way, that this Brexit delay, the deadline moving to October, will naturally have negative impact on investment and sentiment. And the Bank of England, do not know which way rates would go in case of a messy no-deal Brexit. That was actually a pretty shitty comment. So the Bank of England has no idea what they were going to do in case there's a messy no-deal Brexit. Wow. I would have not stated that publicly if I was broadband, to tell you the truth. So pound, difficult to trade at the moment. Please beware if you go in. Canadian dollar, Wednesday CPI, 40 basis points versus 70 prior. So a little bit of cooling off of inflationary pressures there. RBC notes that there may be some uncertainty presented by the new rent methodology that official data will use. It's always interesting to see that the different agencies coming out with different statistics at times change their methodology. For example, the GDP growth in the US, the recent reading was unbelievably strong due to a little trick that was employed by using a lower GDP deflator number. So these tricks is a kind of manipulation using this, right? So everybody is manipulating the market. Everybody who can is manipulating the markets. And it's kind of a joke that you read in the press about markets not getting manipulated, or every information is priced into the price, and you don't need to know anything because you just look at the order book, all information is in there. Bogus. Everything. The order book is manipulated, statistics are manipulated, price action is manipulated, everything is manipulated. The 3 most recent monthly rises, 0.3 to 0.9, are the highest in over a decade. Aha! So rents are rising. We actually have a similar situation over here in Germany. The box Bank of Canada's preferred measure of inflation is the median, common, and trimmed, are expected to rise a bit due to easier base effects. Of course, base effects, if you don't know what that is, if you take a number, 10, your economy grew by 10% last year, and now you're going to 11, that's 1% increase, that's naturally 10% better, okay? But if you go from your economy grew by 1% and now the next quarter it's growing to 2%, then you have a lower base effect. You're coming off of 1%, not of 10%. So you grew by 100%, okay? So that's a base effect. And if you don't know that, that's very, very important to know that, because we're always on a Q-on-Q basis, month-on-month basis, quarter-on-quarter basis. We look left to the past, check out how it was, and then it's all about rate of change. The game is he or she who predicts GDP growth or inflation changes better than another bank makes the most money. That's the game that you're in. If you think you're in technical analysis game, you're not in the game. You are the guy paying us or the gal. All right, on the left-hand side, in Canadian inflation on a month-on-month basis. On the right-hand side, Canadian inflation on an annual basis. And so today you learned that the BOC likes median, common, and trimmed as their preferred measure of inflation. Very good. Last month's average of the three was actually 1.97%. So it could tick up. Again, Canadian dollar highly correlated to oil. Canadian employment numbers last Friday, super solid. If risk sentiment improves, the Canadian dollar is along. End of story. Aussie dollar and RBA. Last slide, I think. Thursday, we have employment change. Here, I added for you the 3-month average because we like to look at 3 and 6 months averages when it comes to these figures. So obviously, we expect employment change to come off a little bit versus the prior number. The RBA will be paying close attention to developments in the labor market at its upcoming meetings. Why is this so crucial? Because, again, slide number 1 this morning, I expected the RBA, based on weak inflation numbers, to cut rates. They did not. They did not do what they're supposed to be doing in the sense of their own charter. So now they said, we're looking at the labor market. We think the labor market is going to improve. We still have some slack in the economy, and that will then yield inflationary pressure via wage growth. Okay, if that's not happening, if we see the labor market weakening, that will then actually incur a higher expectation in the market getting priced in for a rate cut, i.e. weakness in the Aussie dollar. Wednesday, we also have the wage price index expected to tick up slightly, and the year-on-year rate forecast to remain at 2.3%. The participation rate is set to remain at 65.7, and I included that range for you guys as well this morning. Westpac is struggling to see a rate cut in the near term from a small rise in the unemployment rate. So small rise unemployment rate, Westpac says, don't really think they can cut yet. One bad number doesn't make a trend, okay? Again, a central bank will act if they identify a trend in GDP worsening, growth worsening, or inflation growth worsening. The election is expected to add thousands and thousands of jobs. Unfortunately, these are only temporary jobs, and hence they are already seen as one-offs. So don't get super excited if you see a big headline number coming in better than 25.7 thousand, for example, because this may be due to the elections. And again, the quality of the numbers is important. It's always the quality of the numbers. Do we look at full-time jobs or do we look at part-time jobs? ANZ is expecting an August cut as more likely than a June or July one. So the RBNZ, we're talking about New Zealand right now, they cut and they actually said we are at neutral right now and data dependent. The Bank of Canada was on a rate hike path. Then they went neutral. Then the market expected them to cut. Now the numbers are coming in okay. So the market is pricing out a perceived cut. Hence the strength in the Canadian dollar. And on Australia, the market, half of the market expected them to cut. They did not cut. So they still are expected to cut. The question now is when? In June or in July or in August? And that depends on the inflation numbers coming in. Until then, unfortunately, they only come in on a quarterly basis. That was my thinking why they actually need to cut. And based on monthly employment numbers that we see. So you need to look at employment numbers. And every time a shitty employment number comes, you need to sell Aussie dollar off of top edges. I cannot state this more clearly than that. Okay? Thanks, guys. Possible trade opportunity for me, myself, and I is long Euro Aussie off bottom edges. Why? Euro, the commitment of traders report actually indicates a potential long trade. Then we are observing as some of the emerging market bets are getting unwound in the market, i.e. long dollar positions are being unwound, and that is supporting the euro. And we expect positive numbers for this week out of Germany. Number one economy within the EU, i.e. could be potentially positive for the euro. In addition, you just need to open your eyes and look at the charts and you see that everything is getting hit, but the euro is not really getting hit that strongly. So that is inherent strength in the currency. Aussie, we have the trade war going south. We have negative employment numbers expected, which are a major focus by the RBA. The risks to the trade are obviously that the numbers come in differently than expected and or being priced in, and or trade war sentiment turns around and gets positive. I'm waiting for a retracement down to a square up level. I could actually wait until you get to that POC down there at 160.50 as well if you wanted to. But I don't know if the euro will really come off that much. But that is the current opportunity that I'm seeing in the market. All right, guys, I think it's 24 minutes. I'm done. Thank you for showing up. I hope you had a very good last week. I missed you. I hope you have a very solid week coming up. And for the guys in Germany, the next training seminar is booked 75%. So we only have a few slots left. If you're thinking about joining the team, then you can surf over to our website. And thanks to Admiral for the opportunity to present to you guys. And thanks for you showing up on a Monday morning. We and I really appreciate you. And thanks to my traders for supporting the effort here. Thanks, guys. Have a good week. Bye-bye.